Hello Lana, welcome to Manifested e-learning forum. My name is Emily Ngwiri and I'll be taking you through alternative investment analysis. We are looking at November 2015 question 2. Question 2A reads as follows: explain the following economic terms as used in private equity fund structures: carried interest, ratchet, hurdle rate, management fees, and vintage year. So we start off. We are looking at November 2015 question 2. Now we're looking at question 2. Now in this case A. That. So we are being asked to explain what those terms are. We start by looking at carried interest. So one carried interest. That we say that refers to the GPs or the general partners share of the fund's profits, and is usually 20% of profits less management fees. Like that. So we are looking at it from this perspective right over here. We are looking at private equity, and we know that private equity has got a structure like that. We've been looking at this before. So we have the investors over here, you have the PE fund over here, and also the portfolio of companies right over there. So this refers to the general partners, and these are the limited partners right over here. So we're saying carried interest refers to the general partners' share of the fund's profits. So these individuals will have to first of all be compensated what we call carried interest. And we're saying it is usually 20% of the funds of the profits less any management fee that is there like that. So now in light of that, now we can be able to explain what we are saying is the next description, or we're saying is ratchet. And we can say that ratchet is, or it specifies what we can say, the allocation of equity between stockholders and management of the company. That. Or what we're saying is how the distribution of equity is done within the portfolio of companies perspective right over here, between the company here and the management team of the portfolio of companies right over there. It allows the management to increase. We can continue and say it allows the management to increase their allocation and then we can say from time to time. So simply put, the ratchet is how the equity, the allocation of equity between the firm and the shareholders of the portfolio of companies right over there. Now we can move on this other side and explain the next term, which I can see here is hurdle rate. 1, 2, 3. We're saying hurdle rate is the IRR that the fund must achieve, before the general partners, can receive carried interest. So if we are saying that this is the fund and the minimum target it has to achieve before now distribution of profits is done in form of carried interest right over here, that this is the minimum acceptable or the minimum target that is that the fund must achieve before any profits is distributed in form of carried interest like that. So that is what we are saying is the hurdle rate. We proceed and look at the next term, management fees. And we are saying that management fees, for consistency purposes, we just need to underline all of these ones over here like that. So we're saying that the management fees is paid to the general partners. This is the fee that is usually paid to the general partners, and we're saying is the fee paid to the general partners on an annual basis from time to time. So that is what you're saying is the fee that is paid on an annual basis. That is what you're saying is the management fee for portfolio management purposes or managing of the fund itself. Number 5, we are saying we'll be looking at vintage year. And we are saying that vintage year refers to the year the fund was actually established. Refers to the year the fund was actually established. And facilitates, performance comparisons. Performance comparisons there. So that is what the examiner wanted us to explain, and since we've actually explained it in detail over here, the videos that deal with private equity actually cover this. Please look at the study text as well. It has actually been explained very incisively there. Now